interested in some of the comments about the fact that core logistics prices are looking quite expensive, quite low. If we do go into a sort of sharper economic slowdown, even a recession, as some of the stock markets that are suggesting, what do you think happens to those core logistics yields?
Firstly, I wouldn't necessarily say that core yields are low, in the sense that we have negative real interest rates from central banks right now. And if, let's say, cap rates for other property types are 3.5, I think getting a 4.5 net initial for a long-term investment for a good facility is actually a deal to many investors. And it's no coincidence that you see investors lining up for just those types of opportunities. Obviously, on a levered basis, it outperforms that. So I think that's probably the first point I would flag there. Could it go up? Could it go down? I can't tell you for sure, but I think based on the level of capital that we have chasing core deals, it's not. If it goes out, it's not going to go out very far, and it will be based on some macro trend that none of us in this room can really control or probably see.
Partially, it's going to be a factor of interest rates. I mean, at the moment we've seen over the last few days, we've seen interest rates again, or bond yields, shall I say, in Europe actually widening again, with Southern Europe going further out, Northern Europe, US, UK actually hardening. So, I mean, you've got that factor to play with. And again, I think, harking back to what we've been saying here, you've still got this quite big disparity between bond yields and particularly logistics real estate vis-a-vis other asset classes. So you've still got that, if you will, that level of that cushion of comfort in there. And I think coming onto it, what we repeat all the time is we are in a growth sector. If you're looking at where markets are coming, you've still got growth of e-commerce. It's still relatively, particularly in Southern Europe, a small number. That looks as though it's growing. Even in Northern Europe, it is growing. We're seeing what Kevin was saying vis-a-vis Amazon and the others. So I think there's a level of comfort built in there in this sector, which maybe isn't so relevant for other sectors.
I'm summing that up. You've got low interest rates, you've got resilience on the income side, which has been demonstrated in the last downturn, and you've got a growth story on e-commerce. So I think those are facts. And then I think cap rate becomes, I think, sentiment and, where what people think of this. But I think we've got three pretty good facts supporting a positive outlook. And maybe contrary to the previous cycle, if we have again a real estate cycle, maybe this time the logistics yields aren't going to move out as much, and they're going to stay much closer to where they currently are, which would be different from the previous cycle. But I think there is data and there are facts to support that statement.
So the current yields, in a way, is a new norm now. So it might shift a little bit away from them, but
I think there are at least fundamentals. Fundamental drivers to argue for that, yes.
I think the other argument coming back to it is, I think the differential between, say, offices and industrial and retail and industrial, I call it the complete sector, were very, very wide, and I think that narrowing has narrowed for a reason. A, because the investors have realised it's not so much of a Cinderella sector, and B, because the drivers from the occupiers and the drivers from demand are now more, I think, apparent, and therefore that great differential there was, I think that is probably, hate to say new paradigms, I don't want to use that expression, but I think that's changed.